Good evening, everyone. We are going to be going live with this thing in about 3 minutes. And so grab a glass of water and get settled. I'm actually super excited about this particular webinar we're doing. I think that you're going to be insanely happy that you stayed and listened to it. So like I said, in about 3 minutes, we will be officially going live. So stay tuned. All right, everyone. Welcome to this evening's webinar session, Unpacking DSO Affiliations. Boy, is this a hot topic. There's a lot of misinformation out there. There's a lot of questions that dentists have, owners have, as they think about what to do now, what to do in the future, what does retirement look like, sales, multiples of EBITDA, all kinds of stuff when it comes to this topic. So I'm super excited for us to dive in. All of you that are logging in and joining us right now, a couple things. First, as you think of a question in the middle of the presentation, please go ahead and type it into the chat, and we will do our very best to answer those questions throughout the session as well as at the end. Also, if for whatever reason, you've got some connectivity issues, reach out to us. We will have a recorded version of this available in case you need to see that. If you would like to connect with me, you can see in our chat right now. You can go to dentalceopodcast.com, and you can also go to our seminar website. We've got an email address listed. All of that's listed in the chat right now for those of you that want to connect with us. All right, so I would like to introduce you to the principal and CEO of McLaren and Associates, Brandon Monreef. He is one of the most knowledgeable people in this field, in this area of dentistry, and I think it's a huge treat to have him on tonight. It's a huge treat for you to be able to ask him questions directly. And so, Brandon, thank you so much for joining it. You can take it away.
Awesome. Thanks for having me, Scott. Thanks, everybody, for joining us this evening. We're going to fly through a lot of information. As Scott said, I encourage you to ask questions along the way. We want this to be as interactive and productive as possible. My name is Brandon Monreef. I'm the principal and CEO of McLaren and Associates. I've spent pretty much my entire professional life on the business side of dentistry. I spent about 9 years as a dental lender, lending money to dentists all across the country to acquire, start, and expand practices. And then I purchased McLaren and Associates 13 years ago. The business I inherited was a traditional practice brokerage firm that focused on doctor-to-doctor transactions, and built that company over the course of about 6 years. And then 7 years ago, made the conscious decision to expand nationwide and develop a process and a team for providing sell-side advisory for larger practice owners who are looking to go down the DSO or private equity path. So we have 3 offices across the country, 15 people that service our clients on a daily basis. And really, I look at our job being to educate and empower dentists regarding, what's your EBITDA, what's the value of your business, and what are your options when you go to monetize the practice, whether that be in a more traditional sense and sell it when you're close to exit to another clinician, or look to affiliate with a DSO or partner with private equity. And those are 2 very different paths to go down. But tonight we're going to focus on talking about everything involved with DSO affiliations. So I want to level set. We've got, different audience members tonight that have probably a different level of experience and acumen when it comes to talking about the concepts from a DSO perspective. So let's unpack a little bit of terminology. EBITDA has become a big buzzword in our industry. Now, that's certainly not a new word. That's an accounting term that's been around forever. But the reason why EBITDA has become a buzzword is because now that private equity is involved in our industry and consolidating it at a rapid pace, they value businesses predicated upon a multiple of EBITDA. And EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Think of EBITDA as absentee owner profit. So if you didn't work chairside in your practice, after you pay all the overhead expenses, excluding any discretionary or non-recurring expenses, and then you pay associates to do all the dentistry, what is the profit that's left over at the end of the day? And private equity DSOs are going to value your business based on a multiple of that absentee owner profit. We'll get into the valuation metrics in a little bit and talk about valuations. Most DSOs are fueled by private equity or a family office. Private equity is essentially a business that exists to raise capital from institutional investors and high net worth individuals with the goal of deploying that capital utilizing a buy and build strategy. So most private equity firms will raise a fund of anywhere from 10 million all the way up to a couple $100 million with the purpose of deploying that capital, starting or buying, let's say 5 to 10 businesses across many different industries. So what we're seeing with the consolidation of the dental industry is not unique solely to our space. This is happening across all healthcare verticals. It's happening in heating and air companies and lawn maintenance companies and pool service companies. Private equity is buying up small businesses across America, across all industries at the moment. And the way it typically looks in the dental industry is they will look to buy a platform investment, typically a multi-site practice with EBITDA of 2 million plus in a major metro area. They're going to build infrastructure around that platform and then start to bolt on additional practices through acquisitions and utilizing a de novo growth strategy, layering on some startups as well. The goal is to leverage economies of scale to drive down overhead, leverage economies of scale to negotiate better reimbursement rates with payers, increase the bottom line, increase profit, and eventually sell that company to the next financial sponsor at what we call a recapitalization event. You often hear abbreviated recap event. Most DSOs are looking to sell the company to the next investor within a 3 to 5 year time period at a handsome return on invested capital. And that return or that gain, that ROI on that invested capital is referred to as arbitrage. Arbitrage is just a fancy word for gain. Most private equity firms are looking to generate a 0.5 to 1x return on each year of the recap cycle. So most of these PE firms are eyeing a 2.5 to 5x return on invested capital in a 4 to 5 year recap cycle. And at a recap event, the private equity investors, the management team that typically holds equity in the DSO, and the doctors that hold equity in that DSO have the opportunity to liquidate that equity in part or in full, hopefully at a handsome return somewhere in that 2 to 5x return range.
Yeah, because there's going to be definitely people on here that that don't speak money and that don't quite understand everything. So if it's okay, I'd like to maybe really simplify this for a second. All right. How much money does the business make if you're an absentee owner? EBITDA. EBITDA is basically paying all the bills of the practice that are real bills that actually are required to run the practice. So not paying for your flight to the Bahamas and paying for your car. That's not a real bill, right? So all the real bills we pay to the practice, including if we had to pay every dentist like they were an associate, even the owner. Whatever money's left over, we use to pay taxes, we use to pay loan payments for, but whatever money is used is left over before those taxes, before those loan payments is EBITDA. Did I explain that correctly?
Absolutely.
Okay. And so now, EBITDA is going to be part of the formula to determine how much is your group worth? How much is your practice worth? Who's buying it? You said private equity or family offices. So these are kind of like, if you can visualize a big pot of money, someone that has a big pot of money. It could be a really wealthy family office, meaning a wealthy individual, or it could be a group that's raised a bunch of money. They've got a big pot of money and they need to invest in 5 or 10 big companies. In dentistry, they could either buy a big DSO already with the money, or they can try to build one or grow one. And you said they like to go into, if they're going to get a first one, like the platform company, you called it, the first kind of company in dentistry, maybe they're going to get a multi-site group practice or practice group that a private dentist might own. It's going to have 2 million of EBITDA or more per year, and it's going to be in a major city. Did I say that correctly?
Sir.
Okay, perfect. And then you said every 3 to 5 years, they're going to need to kind of have some sort of a event, a liquidity event of some sort, so that when they've grown this company, they can go cash out from it. And that's called a recap or recapitalization event. And the money they make, that increase, that ROI, that arbitrage, that money, they're going to give it back to all the shareholders, which is many times is the private equity group shareholders. But also, did you say maybe the doctors that own stock in this DSO as well? Did I say that correctly?
Yes, sir.
Okay, right. Excellent. Sorry to interrupt. I just wanted to try to simplify it a little bit.
Oh, I think that's a perfect explanation. And then the new financial sponsor of that DSO. So the DSO typically stays intact, right? The management team stays intact, the name, the culture, the assets they own. The new financial sponsor restarts that process and continues to grow and scale the business. And then within a 3 to 5 year window, look to sell it to the next financial sponsor. And we can skip ahead because I think it's important for people to know, how does private equity make money, right? So it's a cost average game. Let's say they're going to buy 100 practices at a cost average of 7 times EBITDA. And then at a recap event, they're going to sell that DSO for 14 times EBITDA. Well, simple math. If you bought at 7 times EBITDA, you sold at 14 times EBITDA, you double your money. However, through the proper use of leverage through debt, it juices the return significantly. And I'll relate it to buying and selling a home. So let's say that you go and you buy a home for $400,000, and 5 years later, you sell that house for $800,000. That's a $400,000 gain. You doubled your money. Well, that's only if you paid 100% cash for the initial purchase of that home. But as we all know, typically you're going to want to borrow the majority of the investment in that initial acquisition. So let's say that you put $100,000 down and you borrow $400,000. And then 5 years later, you sell that home for $800,000, right? That's a $400,000 gain on invested capital. What did you originally invest? You invested $100,000. So that's a 4x return on your initial investment by utilizing leverage to increase your return exponentially. And the same concept that private equity uses when they start a DSO, grow the company significantly, mainly fueled through debt, and then exit that business in a 4 to 5 year window at that 3 to 5x return on invested capital. So when I refer to equity tonight, what I'm referring to is cash and or equity in the DSO. So a DSO is going to invest cash to grow the business in combination with leverage, with debt. And there is an equity component in each of these transactions that a doctor is going to have. So every transaction is either going to have a combination of cash and joint venture equity or a combination of cash and holding company equity. And we'll talk a little bit about DSO deal structures here in a minute. Joint venture equity refers to practice level equity. So think of a joint venture as a partnership. Let's say you're going to do a 60-40 deal with the DSO. You're going to take 60% cash and retain 40% joint venture equity at the practice level. You're going to continue to get 40% of the ongoing profit because it's a true partnership. Whereas in a holding company model, holding company equity is not equity at your practice level, it's equity in the DSO's parent company. And in that scenario, you're not partnered at the practice level, you're partnered at the parent company level. There are no ongoing distributions, but you have the potential for a higher return on holding company equity than you do joint venture equity. And we'll get into the weeds here in a minute when we talk about DSO deal structures. Right. So if we're going to talk about where we're at today, I think it's important to talk about kind of where we've been from the perspective of dental industry consolidation. So DSO version 1.0, this was the clinic style model where all the practices owned by the DSO all shared the same brand and all the decisions were really being made by the suits. It was not provider centric, it was not staff centric, it was not patient centric. It was really focused on one thing and one thing only, and that is making money. And a lot of the suits thought that they were smarter than the dentist. And in large part, DSO version 1.0 is kind of what made DSO a four-letter word. It's what gave DSOs a bad rap. There's actually very few legacy DSOs that followed that DSO version 1.0 blueprint left in the marketplace today. So most of those DSOs crashed and burned and were replaced with the rise of what I'll call DSO version 2.0, beginning about 7 to 10 years ago, when DSOs realized that it's a provider-centric business, it's a staff-centric business, it's a patient-centric business. And they started to operate in a different fashion in the sense that they wanted to partner with doctors rather than buy 100% of practices and then tell doctors what to do. So DSO version 2.0 is focused on buying quality practices from great clinicians and really staying out of their way from a culture standpoint, from an operatory standpoint, from a clinical standpoint. So they allow the doctor to keep complete clinical autonomy and a lot of operational autonomy simply by buying low and selling high and leveraging economies of scale and not trying to reinvent the wheel. Private equity can make a ton of money in our industry. And they've also allowed doctors to participate in the financial arbitrage that the private equity firms are realizing. So when we talk about that equity component in each of these deals, you are shoulder to shoulder with the private equity investors, and you're going to get the same return on invested capital that they're realizing. So as a result of evolving to this more provider-centric model that offers more autonomy and allowing the dentist to invest alongside private equity, it has become a viable, legit transition option, depending on your why, depending on how your practice is designed economically. So version 2.0 is here to stay. And I think it's enabled DSOs to kind of overcome a lot of the bad press that they got early on in that version 1.0 model. The other reason that I think DSOs have become so prolific and that many people have looked to partner with DSOs is the rise of the group practice model. Up until about 7 to 10 years ago, there were very few multi-location practice owners. I mean, Scott, you were one of the early multi-location practice owners, especially in the San Antonio area. So there has been a huge push towards the group practice model and the multi-specialty model and the multi-location model. So as a result, we've got a lot of massive multi-million-dollar revenue practices, EBITDA well over 500,000, if not well over $1 million. Those practices are difficult to sell in the private buyer world, and they're far more valuable in the DSO world. So these two market conditions really collided and created a perfect storm whereby DSOs want to buy larger practices. Private buyers don't. They can't afford to, or they don't have the confidence or the competence or the skill set to knock down a multi-million-dollar multi-doc practice. So the confluence of these two market conditions is one of the reasons that the consolidation of our industry really caught fire, 5 years ago and has not looked back. So let's talk about pre-COVID market conditions. Dentistry was arguably the hottest vertical that private equity was investing in going into COVID. Private equity had identified dentistry as really a perfect fit for their buy and build and exit strategy. So as a result, there were about, I'd say 100, maybe 150 DSOs operating nationwide pre-COVID, and private equity loved dentistry. Obviously, all of your offices were shut down for anywhere between, 30 to 90 days during COVID. But as they opened up, dentistry rebounded faster than any other healthcare vertical. I mean, dentistry has been far ahead of, sterilization and airborne illness than, many other businesses, even in the healthcare space. So your patients trusted you. You were already ahead of the curve from the sterilization and airborne illness perspective. They came back to your office very, very quickly. So when private equity saw dentistry rebound extremely fast post-COVID, then they were head over heels with our industry and they doubled down. Those DSOs that were already buying practices pre-COVID started buying practices at an even faster clip. Those private equity firms that were eyeing an investment in dentistry pre-COVID pulled the lever, bought a platform, and started building a DSO. So the number of DSOs tripled almost overnight from 21 to 22. And as a result of a rapid increase in demand, valuations increased in turn. So from the back half of 21 through the front half of 22, we saw valuations go up from 30 to 50% across all specialties in the dental industry. So a huge bump in valuations in 21 and 22. And that's really where valuations peaked, where they reached an all-time high. The market was very frothy. A lot of people took their practices to market and monetize them in that 24-month period. And many DSOs were paying elevated multiples and really buying everything they could get their hands on. They weren't doing a lot of diligence. They weren't really integrating and operating the practices that they were acquiring. And they weren't building the infrastructure fast enough to handle the growth of their business. And over the past 24 months, the market has suffered as a result. Some DSOs have recognized significant growing pains given that they paid elevated multiples. They grew extremely rapidly in 21 and 22. And then almost overnight, interest rates doubled. And that put a lot of DSOs under, financial and operational stress. So over the past 18 to 24 months, we've seen valuations normalize. We've seen some DSOs on their heels and not buying at all, or certainly not being as aggressive as they have been previous to the past 24 months. So it's been kind of a reckoning, over the past 18 to 24 months. There's a handful of DSOs that didn't survive it. There's a handful of DSOs that have had major operational and or financial turmoil. And then there's been, some DSOs that were built on a strong foundation that have thrived over the past 18, 24 months while everybody else was on pause. So that really brings us to today. And we have seen more optimism over the past 6 months than we saw in the previous 24 months for multiple reasons. Obviously, I know there's a lot of chaos in the market, the stock market, as well as with interest rates over the past week that I'm not necessarily going to speak to because there's still a lot of uncertainty in that regard. But market conditions from a macroeconomic perspective are improving for private equity. So we are now in a declining interest rate environment. I expect rates to continue to decline modestly over the course of the next 12 months. Interest rates impact private equity to a large degree because we are talking about heavily leveraged businesses. I talked about before, through the use of debt, through the use of leverage, that's how private equity significantly juices the return on their investment. So most of these DSOs hold a tremendous amount of debt. Therefore, interest rates play a major role in their health and their buying behavior. It's good news now that we're in a declining interest rate environment. We also saw, from a private equity perspective, a favorable election outcome. Private equity views Trump as an ally, in the fact that he is pro-business and they feel that the economy will do better long-term under his leadership as opposed to the other alternative. Now, if you asked them over the past week, They might have a different opinion. But the reality is a lot of the chaos that's happening in the stock market is actually good for private equity. When the stock market experiences a downturn, investors seek yield in other asset classes, and it typically pushes money into private equity as investors look to diversify. So a downturn in the stock market, a recession that causes a further downturn in interest rates will be positive for private equity and will actually fuel demand for dental practices in the years to come. So we're seeing renewed interest in the dental space over the past 6 months. And that's evidenced also by the fact that we've had multiple recapitalization events in Q1 of 2025, the most notable being MB2, one of the top 5 largest DSOs in the country, recapped at a favorable return here just recently. And they have actually hit 3 recaps over the course of 10 years, yielding, a 16x return on equity. So I think we're going to see more recaps occur over the back half of the year. I know for a fact that there's 7 DSOs currently on market that have offers in hand that we expect to announce recaps over the next 6 months. So the current macroeconomic environment is much more favorable than it's been in the previous 18 to 24 months. I don't think that we're going back to where we were in 21 and 22. I don't think that valuations are going to possibly ever return to where they were in 21 and 22. But valuations remain elevated and I think will remain stable for the foreseeable future. That said, as a result of some of the lessons that DSOs have learned over the past 24 months, as a result of some of their operational and financial turmoil, they are operating with increased scrutiny from their investors, their banks, and the institutional investors that buy these DSOs at a recap event. So they are also being more prudent in evaluating the acquisition opportunities that are hitting their desk. So they are being more selective about the assets they're acquiring and more responsible in how they're structuring their deals. So deal structures have started to evolve to preserve cash and align incentives with their doctor partners. They want to make sure that they have alignment with their doctors at both the parent company level, the DSO level, and the practice level. So you're seeing a lot more joint venture deals. You're seeing more earnouts, more holdbacks that are tied to practice performance post closing. And I think we're going to see more and more of that on a go forward basis because DSOs are focused on mitigating risk. They're introducing more structure into the deals to protect downside risk and to show investors on the back end when they go to recap that they've been behaving in a more responsible manner than they did in 21 and 22.
So some people may not understand what earnouts are or holdbacks are. An earnout's kind of like, hey, I'll give you this huge valuation, but only if you hit this projected number you say you're going to hit. If you hit that number, you'll earn the rest of this valuation. If you don't hit that number that you say you're going to hit, then you don't get that. That protects me, the private equity group, in case I bought something assuming it was going to be bigger than it really was. Did I say that correctly?
Exactly. There's really 2 forms of holdbacks. There's what we call like a maintenance holdback. So look, if you keep the numbers same or better as they were at the time we partnered with each other, then we're going to pay you out, whatever sum of money we held back over the course of typically a few years. And then there's upside earnouts or holdbacks, where if you grow the business post closing, you will actually earn additional payouts above and beyond the initial valuation. So our goal as sell-side advisors, we represent sellers, we don't represent DSOs, is to bring our clients the cleanest deal structure possible, meaning a combination of cash and equity. But we have seen more earnouts and holdbacks creep their way back into these deal structures as DSOs look to mitigate risk and preserve cash. So our goal is in that scenario to negotiate the earnout to make it as favorable as possible and as achievable as possible for our clients. So I talked about the fact that DSOs are scrutinizing the acquisition opportunities that are coming across their desk and being more prudent about the practices that they're acquiring. And I think it's important to understand, what moves the needle from the perspective of a DSO to make your practice as attractive as possible, to position yourself as a Class A asset. This is what DSOs are looking to acquire. The majority of the time, they're looking for practices located within 60 miles of a major metro area. So geography does play a role. And that's simply because of the challenges that practices that are located in a tertiary market or a rural market have when it comes to recruiting, both staff and doctors. It's easier to recruit when you have a larger labor pool to pull from, which is why they love practices that are located in urban and suburban markets. DSOs also love to build density in a particular geography. And it's very hard to build density when your practice is located in a tertiary market or a rural environment. Much easier to build density when you're in an urban or suburban market. Key man risk has become a huge talking point for DSOs. They have recognized that provider turnover, in particular founder turnover, is their Achilles heel. So they're trying to mitigate key man risk by bifurcating the production across multiple providers. So the practice with a single provider, one doctor practice, super producer with an expanded skill set doing 3 million is going to see less demand and a lower valuation than a practice with $3 million in annual revenue where the production is bifurcated among 3 providers, right? That 3 doctor practice has a lot lower key man risk than that single doctor super producer practice. So most DSOs are interested in buying practices that have multiple doctors or can at least accommodate multiple doctors. So that's where you need to pay attention to your facility. If you ultimately want to partner with a DSO, you've got to have 5 or more ops, ideally 8 or more ops. You've got to have the capacity to accommodate multiple providers, whether that's multiple general dentists or a general dentist in multiple specialties. They want to see a reduction in key man risk through growing the business by adding additional providers.
So one question that was asked is, how are these trends similar or different for specialty DSOs?
They're actually not very different from a specialty DSO perspective. All of these trends really apply across the board. That said, there has been massive consolidation in the specialty space over the past few years. I would argue that OMS practices and pedo practices, pedo ortho, pedo practices have been the hottest commodity in the space where we've seen the most demand and the highest multiples because we have specialty specific DSOs that are chasing those opportunities. And then we have general dentistry focused DSOs that are pivoting in markets where they have significant density to layer on specialty practices. But all of these trends apply really universally to both general dentistry practices and specialty practices. About half of our clients are specialty offices at any given time. We've got pedo, ortho, OMS, perio, and endo practices on the market. I think right now we have at least 2 of each specialty practice on the market across the country. And about half of what we do is large multi-doctor general dentistry practices.
So back to the key man risk. If I am a super producer, I could probably expect to either have to replace myself with a couple dentists before I go to market in a way so that I'm not key man anymore. We have several. Or if I am able to sell to a DSO, I could probably expect terms that force me or make me want to stay longer so that the DSO can work to replace me, the key man. Did I say that correctly?
It's a great point. So if you are a super producer, if you are a one doctor practice, you still have options, right? We sell plenty of single doctor practices to DSOs. However, because there's more key man risk, you might expect more structure in your deal, right? You might have a holdback or an earnout to keep incentives aligned and to keep you motivated to continue to produce. But if you want a shorter term post-closing commitment, if you want a super clean deal structure, if you want maximum demand, it would behoove you before going to market to bring on another provider and start mitigating that key man risk yourself so that you can potentially have a higher valuation, more demand, and a cleaner deal structure, and maybe a lighter post-closing commitment as opposed to a 5-year commitment. Maybe you're only looking at a 2 or 3 year commitment if you physically are responsible for less than 25% of global production in your business.
Also, you keep saying structure. So those of y'all that don't understand what that is, let's look at a deal in very simple terms. You get money or stock, right? So you get paid, but the structure says, okay, well, what are all the rules around that? You know, you get some now, do you get some later? Do you get it all now? Do you have to earn a certain amount, or do you have to stay a certain amount of years? That's structure. And so often structure is as important as the number that's on the paper. So the structure is used to incentivize the seller to do what's good for the buyer. Structure is also used to mitigate the risk of the buyer in the deal.
Absolutely.
All right, one last question. Geography. I'm thinking a particular client right now that's actually on this webinar, and they've got this practice that's doing very, very well, but they are in a tertiary market. And it's very likely they'll get to $1 million in EBITDA in one location in a tertiary market. There's less demand for them. Is there still demand for practices by DSOs in tertiary markets?
Absolutely. It will be all things equal, right? A practice in an urban environment will have more bids and maybe garner a slightly higher multiple. But we sell plenty of practices that are located in tertiary markets, and it's typically easier to get to $1 million in EBITDA in a tertiary market because your overhead's lower and you have less competition. You should expect that there may be a joint venture component to that deal where you retain some practice level equity, because you as the founder are going to be very difficult to replace when you depart. So the DSOs, again, are going to want to mitigate that key man risk through structure, whether that's joint venture equity or some type of earnout or holdback. All of these deals have some level of structure to them, right? Like a private buyer sale is typically 100% cash at closing, and you can sail off into the sunset in short order. A DSO deal is likely going to garner a much higher valuation, but there's going to be strings attached. There's going to be structure. There's going to be an equity component, possibly a holdback or an earnout, and you're going to have to agree to stick around for a while. So moving on, most DSOs are focused on acquiring practices with EBITDA of at least $500,000 or more. Now, if your EBITDA is in that $200,000 to $500,000 range, there's still demand out there for that, but it's likely going to come from regionally based DSOs, and you're not going to trade at as high of a multiple. You're not going to receive as many bids as a peer with a larger practice would. So to large degree, the level of EBITDA significantly impacts the multiple and demand. It takes the same amount of effort, of money, of brain damage to close a deal with $200,000 in EBITDA that it does to close a deal with $2 million in EBITDA, right? It takes the same amount of resources for a DSO to close both of those deals. And they have a finite amount of capital and time. So they're all about efficiency. They would rather acquire a larger practice as opposed to a smaller practice. And ideally, you're operating at a 20% EBITDA margin. So just to back into these numbers, if DSOs are looking for EBITDA of $500,000 plus, and a healthy practice operates with an EBITDA margin of 20%, you're going to need to be generating revenue of $2 to $2.5 million a year to hit that metric. So it tends to get really compelling to look hard at the DSO option when revenue crosses about $2 million a year, comparative to a more traditional sale to a private buyer. That's where demand and valuations in the DSO world significantly accelerate, and the delta between the DSO valuation and the private buyer valuation increases exponentially. DSOs are very focused on same-store sales growth because of some of the turmoil, some of the trauma that they've been through over the past couple of years, because institutional investors at recap are paying very close attention to how efficiently these DSOs are operating the practices they acquire. In other words, great, you can go out and buy EBITDA, right? You can go out and acquire practices. You've proven that. But do you grow the practices that you acquire? So same-store sales growth has become a huge talking point in the DSO world, especially at the point that these DSOs go to recap, especially as some DSOs are eyeing an IPO. So they want to see that you have an increasing revenue and EBITDA growth trend. they're also going to be paying very close attention to post-closing growth potential, right? Can they improve your reimbursement rates with payers via leveraging their economies of scale? Can they drive down your overhead costs through leveraging their size and their economies of scale? Can they grow your practice through expanding the procedure mix, layering on specialty services or adding additional providers? You always want to go to market with a growth narrative. So if you've got increasing revenue trends, increasing EBITDA trends, that's going to be fantastic. And then we also want to lean into what are the other growth opportunities that exist in your business post-closing. And if they feel that they can grow your business significantly from a top line perspective and a bottom line perspective, they're going to pay a higher multiple. They're going to pay a higher valuation because they know that they can buy down that EBITDA multiple through EBITDA growth post sale. And then doctor alignment and retention, not only with you, the founder, the owner, but also with your associate doctors. So I'm going to talk about in just a minute, making sure that you have alignment with your associates and any junior partners that you have is critically important because the buyers are going to want to make sure that everybody's going to stay on post sale. Replacing a founder and or replacing major producers is difficult in today's environment. And they're going to make sure that they have doctor continuity because, at the end of the day, that's what's going to drive post-closing stability and growth. So leading a little bit more into practice valuation metrics, I already mentioned that a healthy EBITDA margin is 20 to 25%. Here are the other factors that really impact the EBITDA multiple. And I want to make this point here. Everybody asks me in any webinar and any podcast, hey, Brandon, what do multiples look like? Everybody wants to talk about the EBITDA multiple because it's relatively easy to understand. EBITDA impacts the multiple more than anything else. EBITDA impacts the valuation more than anything else. So when we talk about your practice trading for an EBITDA multiple, let's say you have a $2.5 million top line rev practice with a 20% margin, that's $500,000 in EBITDA. And let's say it's trading for a 7x multiple, right? So it's trading for a valuation of 3.5 million. Okay. Every dollar of EBITDA is worth $7 of value. So EBITDA, controlling that narrative regarding EBITDA and making sure that you get credit for all those discretionary expenses you're writing off through the business, the personal expenses you're writing off through the business, for any one-time or non-recurring expenses, like if you just remodeled your office or bought a cone beam or whatever it was, we have got to control the narrative regarding EBITDA because every dollar of EBITDA is going to be worth $7 or more in practice value. And controlling the narrative regarding EBITDA is the number one way that we move the needle on valuation for our clients. Because control the narrative regarding EBITDA is also the number one way that DSOs are predatory and that take advantage of dentists that don't have proper representation. They will dangle the carrot of a sexy EBITDA multiple, but try to convince you that your EBITDA is $200,000 less than it actually is. So for example, I went through the example of a practice with $500,000 in EBITDA that's trading for a 7x multiple, a $3.5 million valuation. If you have us at the table properly controlling the narrative regarding EBITDA, creating a competitive environment, and holding the buyer's feet to the fire. But if you're on your own and you don't have proper representation, the DSO might say, hey, doc, we're going to pay you an 8x multiple, sexy EBITDA multiple to get your attention. But then they're going to say, well, we're going to run the numbers and we'll come back to you and let you know what your EBITDA is. Well, your EBITDA is 300,000 on a 8x multiple. Your valuation is 2.4 million. You don't know your numbers and you aren't aware of how to position your practice to defend that EBITDA and get full credit for all of those addbacks. You leave over $1 million on the table, right? 8 times 300,000 is 2.4 million. I'm representing you. EBITDA is 500,000 at a 7x multiple. It's 3.5 million. So those are the games that DSOs play when we talk about EBITDA and we talk about taking advantage of doctors that don't have proper representation, aren't controlling the narrative regarding EBITDA. So
yeah,
I'll get Go ahead.
Another issue with this is most doctors don't have clean financials to begin with. And so they've been running their financials so that their tax man once a year can minimize the taxes they pay and kind of maximize the expenses they show. And so on one hand, we got to clean up the financials and of course be very particular and thoughtful about how we allocate money you spent. Was it a real cost? Was it a one-time cost? Was it a personal thing that you just threw into the company? All changes your EBITDA. Second is you got to have someone like McLaren Associates represent you so that they can go and be the protectors of that number, so that you are not manipulated in the negotiation with DSOs as they try to give you reasons why you should chip away at that EBITDA number. But also, before you even have this kind of conversation with the DSO, you need to go in and make cuts and clean up and maximize the actual EBITDA that you have. Great example is I'm working with a 2-location group. They do 12 million in collections a year out of 2 locations. We found over $800,000 of cuts they needed to make, overspending on supplies, on lab, on credit card fees, on IT, on subscriptions, on staffing. 800 grand at their level is probably worth like $5 million extra valuation. That's 5 million after they pay off their debt, an extra 5 million, which would be life-changing for them. So we have to remember those things. Clean up your financials to get a proper EBITDA number, have representation to protect it. But before you even do any of that, go change things in your practice to cut needless expenses so that you are showing the biggest EBITDA you can.
Absolutely. And that's why we encourage doctors that own, large successful practices that may be planning to go to market in a year, 2 years, 3 years. Do evaluation now. Do an EBITDA analysis now so that we can guide you to reverse engineering the outcome you ultimately want to achieve, so that we can clean up your P&L. Make sure you report all your cash revenue that's coming in the door, so that when you get to the point that you want to go to market, you have the cleanest financials possible and it's clearly visible without a heavy lift to identify what your EBITDA is. But a lot of people don't do that, and they call us the day they're ready to go to market. And that's why I have a CPA on staff and I have financial analyst on staff, because we are very, very technical when it comes to going through the numbers and fighting for every add back we can possibly get, both pre-LOI, before the DSOs make an offer on the practice, but also navigating the quality of earnings process. Once you accept an offer and move into closing, there's a rigorous diligence process that DSOs go through to basically verify that the EBITDA that they bid on was true and accurate. So you've got to have somebody position your practice properly on the front end to control the narrative regarding EBITDA, and then defend that EBITDA throughout the process in order to maximize value. But let's move on and talk about what impacts the multiple, because the multiple matters as well. EBITDA matters more, but the multiple obviously matters. The EBITDA level itself, and we can see kind of the demarcation points over here. The higher the EBITDA, the higher the multiple. Number of doctors, again, talking about mitigation of key man risk. The more doctors, all things equal, typically the more bids, the higher the multiple. The number of locations. The number of locations will move the multiple slightly, not significantly typically. However, there's kind of a misnomer here. More locations does not mean a higher valuation. More locations comes with more overhead. So I would much rather take a single site practice to market with $5 million in top line revenue and $1.5 million in EBITDA than a 3-location practice with $5 million in top line rev and only $1 million in EBITDA. Yes, the 3-location practice might trade for a slightly higher multiple, but that single site office is going to trade for a much higher valuation because the EBITDA is 50% higher than their peer that owns a 3-location practice with the same level of revenue. So be very intentional about how you engineer your business, because I have conversation after conversation. I feel like somebody a few years ago convinced dentists that the more locations, the better. It doesn't matter how efficient you are. It doesn't matter what your EBITDA is. And I always have conversations with doctors where they call me and say, "Hey, Brandon, I've got 7 locations. All right, I'm getting excited. My revenue's 9 million." And I'm like, God, I know right off the bat your EBITDA margin probably sucks, because when your average revenue per location is 1.2 million, it's going to be difficult to generate any meaningful level of EBITDA, and you're likely operating relatively inefficiently given that you're spreading your time across 7 locations when you could be doing the same amount of revenue out of 2 or 3 locations. We talked about the fact that geography matters. Again, this comes down to competition. The more suitors you have, the more bids we receive. Typically, the higher the EBITDA multiple and the higher the valuation. So, practices in an urban, suburban geography are likely going to trade for a higher EBITDA multiple because you're going to have more demand than practices located in a tertiary market. Infrastructure. If you are a multi-site practice that has significant infrastructure and has EBITDA over $2 million a year, you could be viewed as a platform investment for private equity where they're going to buy your business as a launch pad to start a new DSO. And that could lead to a significantly higher EBITDA multiple. However, it's like number of locations. Infrastructure comes at a cost, time, energy, and money. Infrastructure erodes EBITDA. Therefore, I'd much rather you focus on growing your EBITDA and being efficient than building infrastructure. It's going to result in you having a much higher valuation at the end of the day. The higher your EBITDA, the more efficient you are, the higher your valuation, the better the outcome. So be very intentional. If you get to an inflection point where you're looking at building centralized infrastructure, be very, very intentional about what that means. That means that in the interim, you're going to erode your EBITDA through making that investment, and you're going to have to grow your business exponentially just to get back to even. You're going to have to grow your business exponentially times 2 for it to be accretive to your overall valuation. The payer mix matters to some degree. Most DSOs like PPO, they like fee for service. If your Medicaid exposure crosses about 25%, it's going to start to limit demand and therefore hurt your valuation. The one exception there is pedo practices. Most DSOs that have exposure in the pedo world understand that you're likely going to have some level of Medicaid in your practice. In the pedo world, once Medicaid crosses about 40%, it does start to hurt demand and hurt valuation. And that's really for one specific reason. Private equity hates regulatory oversight, and Medicaid comes with a lot of compliance and a lot of risk from a regulatory oversight perspective, even though in some states, Medicaid reimbursement rates could be higher than PPO reimbursement rates. The service mix. How broad is your service mix per provider? If you're a super producer that's got a really expanded service mix and you're doing everything that walks in the door and referring nothing out, you're going to be hard to replace when you're ready to exit that business. It elevates key man risk. It can hurt demand, hurt valuation versus a bread and butter practice or bifurcating the production across multiple providers. And those may include specialists. Upside potential. You always want to go to market with a growth narrative. If the DSO believes they can grow your top line and or bottom line significantly post-sale, they will lean in, pay a higher multiple, pay a higher valuation. Your post-closing plans, what does your runway to exit look like? Ideally, you want to position your practice with a 5-year runway to exit. That doesn't mean you have to practice chairside for 5 years post-sale. It just means that you're going to have a vested interest in the business for up to 5 years post-closing. If you want to cut back significantly, if you want to step away chairside completely, you're going to have the autonomy to do so long as you backfill your production with associate doctors. All the DSO cares about is the business performing same or better globally post-sale as it was at the time of closing. They don't care who's producing the dentistry. All they care about, are you maintaining EBITDA? And your personality, this one surprises a lot of people. They think private equity is solely focused on the financials. If private equity falls in love with you, they will pay more for your business. And that's why we tell our clients, hey, let us handle all the negotiation. Let us handle all the posturing. Good cop, bad cop. Let me be the bad cop. I'm the guy that's responsible for controlling the narrative regarding EBITDA, for creating that competitive environment, for holding their feet to the fire, for handling all the negotiations. You focus on getting to know the people. Focus on fit. You don't have to posture at all. Talk about your passion for your patients, for your team, for dentistry. Let us handle everything else. And that's how we're going to ensure that we get the best outcome we possibly can. So this is kind of a new slide to my presentation, aligning incentives with doctor partners and associates. It's because the producers in your practice, are going to have to be complicit with you pursuing a DSO affiliation. And if they are not on board, if they dig their heels in and refuse to go to work the day after closing a DSO affiliation, it's going to impact you. It could hurt the probability of your deal closing in the first place, and it could obviously hurt post-closing performance of the business. And if you have an equity component and or some type of earnout or holdback, that's going to hurt you. That's going to harm you. So you want to make sure that you make promises thoughtfully with your associate doctors or your minority partners. If your plan is ultimately to pursue a DSO affiliation, then you need to make sure you position the conversations with your associates and minority partners appropriately. And the more partners you have, the more associates you have, the more challenging it can be to get to a closing in a DSO affiliation. You're going to want to make sure that you have a unilateral legal right to sell the business to a DSO without the approval of your associates and or partners. That's called a tag along or drag along right. You're also going to want to make sure that your agreements with your associates are assignable upon sale to whatever DSO partner you so choose. And you're going to need to be prepared for the fact that you might have to incentivize your associates to go with the flow through some type of retention bonus and or equity at the point of sale. Most DSOs now have some on-ramp to equity for associate doctors, again, because they understand that founder turnover, but provider turnover in general is their Achilles heel. They're going to want to incentivize not only you, but your associate doctors to remain with the practice long-term. And the way to do that is to incentivize them financially to have alignment at the practice level. And that may involve giving or selling them equity, whether that be at the practice level or the DSO level. So deal structures, Scott, you mentioned earlier that all of these deals are going to have some structure to them. A private buyer deal is going to be relatively cut and dry, typically 100% cash at closing, and you're going to sail off into the sunset in short order. In a DSO deal, there's going to be a post-closing commitment of anywhere from 2 to 5 years, and there's going to be structure involved. I could literally spend all night talking about the different types of DSO deal structures, but I think at a high level, there's going to be a cash component. That cash component is going to be somewhere in the range of 50 to 70% of the valuation of the business. Then there's going to be an equity component, whether that's holding company equity, equity in the DSO's parent company, or joint venture equity, retained equity at the practice level, or a combination of the two. And then there could be a third bucket being some type of holdback or earnout that's tied to you fulfilling your post-closing employment agreement, as well as the practice performing same or better post-sale. So there's going to be significant structure in all of these deals. My job is not solely to help you negotiate the highest valuation. My job is also to bring you perspective and optionality by bringing you multiple offers with different deal structures and helping align that deal structure with your why, with your goals. So I would argue that fit and deal structure are as important, are more important than the initial valuation, especially when we're talking about an equity component that's going to be significant. The equity could be anywhere from, 49% all the way down to 10% of your valuation. If you pick the right partner and achieve that 3 to 5x return on equity within that 4 to 5 year recap window, that's going to be incredible. But if you pick the wrong partner and that equity doesn't have value and that DSO is not able to get to a lucrative recap event, you're leaving a ton of money on the table. So it's our job to vet these DSOs, only bring the best options to you, create that highly competitive environment, bring you multiple offers to provide you with perspective and optionality, and then help you negotiate the highest valuation and the best deal structure for your particular situation that we possibly can. So keys to maximizing your outcome at a sale. First of all, we talked about what DSOs are looking for previously. Position your practice to be considered as a Class A asset, because Class A assets, we have not seen a huge downturn in valuation since 21 and 22. We're talking about multi-million-dollar revenue, multi-doc practice, EBITDA of $500,000 plus, 6+ operatories in a suburban or urban geography, and upside potential post-sale. Choose the right time to take your practice to market. I'm not talking about timing the market, right? What I'm talking about is choosing the right time to take your practice to market from a practice level performance perspective, right? Go to market when your EBITDA is as high as possible, when your revenue and EBITDA trends are positive, and where you have significant runway to exit. Obtaining proper representation. You've got to have a strong sales side advisor at the table if you want to maximize your outcome. So you need McLaren at the table. You're going to need a great dental attorney that's fluent in DSO transactions at the table. You're going to need your CPA at the table to talk about mitigating tax consequences. You're going to need your financial advisor at the table to talk about what to do with that windfall with the cash at closing, and also evaluating, are you at a point in your career and your life where you can afford to monetize the business? And then you need to have your spouse involved in the conversation as well.
I might add one more team member.
Yes, sir.
Before this, you're probably going to want at least a year, maybe even 2 years of practice management coaching or consulting, knowing, with the sole purpose of, hey, we're going to take this thing to market, because that is going to maybe give you as much increase in valuation as all these other strategies combined. Because you have time to maximize the EBITDA. You have time to replace yourself with other associates. You have time to get rid of, the last 10% of Medicaid involvement you have in the practice. Like, you've got time to build up collections to show positive revenue growth. And that's time that's going to take 1 or 2 years with a practice management coach, probably, to put you at your best. And it's definitely a tiny cost in the big scheme of things.
100% agree. What's amazing about getting a great coach like you, Scott, is that for every dollar you increase the EBITDA, you're getting $7 or more in value in return when you take the business to market. And the cost of your services is an add back. It does not hit EBITDA.
Yeah.
So the return is exponential on that investment. And that's why it's so important to start these conversations early, so that they have the opportunity to work with you. They have the opportunity for us to do a deep dive on the financials and quantify where their EBITDA currently sits and what the strengths and weaknesses of their business are, and then coach them alongside you as they eventually look to take the practice to market, so that we can reverse engineer the best outcome possible.
So I know we're kind of running low on time, but let me add something too. So what you spend on a consultant is what we call an add back, meaning it doesn't count against your EBITDA. What you spend on your personal expenses, like your car or like your kid or your vacations or your meals or your cell phone, is an add back. Also, if you're involved in a lawsuit and you have a one-time expense, if you bought equipment, that is added back, because that should not be on your profit and loss statement. That is not an ongoing expense. You wouldn't buy a pano every single month for in your practice. So this is why you so importantly need this team in place. So you don't know what you don't know. And a lot of this is pretty straightforward to do if you just have the right team and you just have the right time.
Absolutely. Because the DSO is not going to add that stuff back if we're not at the table, right? They're going to give you credit for any of that. The name of the game for them is to buy low and sell high. They're very opportunistic in that way. And look, I don't blame them, right? Their job is to protect their investors and generate a great return. Our job is to keep them honest and protect you and ensure that you maximize your value when it's time to take your business to market. So that brings me to the next one. Do not respond to an unsolicited offer. DSOs have built marketing machines and referral networks designed for you to be introduced to them without proper counsel at the table and do a deal in the dark without having representation. And ultimately, if that's what you choose to do, you run the risk of, one, selling prematurely or selling to the wrong DSO, leaving significant money on the table. I'm talking about millions of dollars on the table for a lot of you, and ultimately accepting a deal structure that does not align with where you're at in your life and your career and your why. So please do not respond to an unsolicited offer. DSOs are not your friend. And, if you have a buddy that sold to a DSO down the street that wants to make an introduction to the DSO that they sold to, just understand they're being compensated to do so. So they might have your best interest in mind, they might not. There's a lot of money in the private equity world that exchanges hands under the table, and nobody's going to tell you that those things occur.
Well, your buddy's not the expert. Your
Right.
buddy wouldn't even know, even if your buddy has really believes this is a great DSO, they do great deals, and they really love you and want you to have the best life you can. The reality is they're just someone that did it once or twice. They don't see the entire market and truly understand the full scope of opportunity. So they mean well, and maybe they're one little voice that you hear, but that is not what you base your trust and your direction on, is what your buddy says.
Absolutely. Everybody's got a different why. Everybody's at a different place in their career. Everybody has a different practice, right? That has different attributes. So if we take 5 people to market tomorrow, there's a high probability that each of them sells to a different DSO based on their unique situation. So brings me to the next one. You got to create a competitive environment. You have got to be in a multiple offer situation if you want to maximize demand, valuation, and optionality. It is absolutely impossible for you to have perspective if you only talk to one DSO. If you met one DSO, you met one DSO. They are all unique. They're all different. So it's critically important to create perspective through competition and optionality. I don't mean to beat a dead horse, but you got to control the narrative regarding EBITDA. Every dollar of EBITDA worth $7 or more in value. That's the number one way DSOs are predatory. It's the number one way we move the needle significantly on valuation for our clients. And the devil is in the details: fit, deal structure, the equity component. What is your comp going to look like along the way? What are your benefits going to look like? What are your rights at recap? There's so many nuances and so many details in these deals that are critical to pay attention to, because it all matters. Our process really involves first scheduling a confidential discovery call. This is a casual call with me. It's 30 minutes for us to just get to know each other and talk about your goals, talk about your practice, and figure out, is now the right time to do an EBIT analysis, to do evaluation, to quantify what is your business worth. And you will feel no pressure from me once we get through that process to take your business to market. If it makes sense to sell, great. We'll make sure that you crush it. We'll protect you, build a strong team of advisors around you, and make sure they maximize the outcome. But if we get through that process and we decide it's not the right time, or it makes sense for you to work with Scott for a couple of years to groom the practice to go to market, to increase your EBITDA and increase your value, we'll hit pause in the conversation and we'll update the valuation at no cost when you are ready to go to market. We spend a lot of time with our clients during the discovery call, the valuation process, to educate you about how this world functions, what your business is worth, what the strengths and weaknesses are, how marketable your business is going to be if and when we take it to market. And our sole goal is to take it to market at the right time and maximize the outcome when we do so. And when we get through that valuation process, an hour later, and you decide that it's the right time to go to market, we're essentially going to take the market to bid, take the practice to market with a bid process. Our job is to create a bidding war among as many suitors as possible to provide you that competition, that optionality, that perspective, and negotiate the most favorable outcome we possibly can. We help you interview and vet all the potential buyers. We help you compare and contrast the offers. We determine which buyer or buyers to negotiate, ultimately sign a letter of intent, and then we shepherd you through the closing process from start to finish: quality of earnings, EBITDA defense, legal, and then integration and closing. We quarterback the process from start to finish. Our sole goal is to make sure that you win and don't get taken advantage of.
I got to add something here. So there's something called deal fatigue. This is where it's so strenuous to do this on your own, to go through what they call quality of earnings, meaning defending, finding every document, everything you spend on, every receipt, having clean financials, and talking to accountants and pushing back constantly. What's this? What's that? And there's all these surprises and all these disappointments. It's just a very chaotic, busy situation that by the end of it, you're just exhausted. You're emotionally spent. You just want to get the deal done. You're so close. And then at the very end, the buyer, the DSO, drops a bomb on you and says, well, we found this, and so we're dropping your valuation by $1 million. You're so fatigued at that point that you're just kind of already pot committed to the whole thing. I just want it done fine, and you do it. It's really tough to see that happen, and it's very common. When you have representation, protection through like McLaren Associates, they are taking a lot of that fatigue away from you. They're shielding you from it. They're answering the questions for you. They're getting you prepared so that there's less fatigue to begin with. There's less steps, there's less conflicts, there's less arguments. And when someone tries to drop a bomb, they pick it up and throw it right back at them and say that's not appropriate, and they fight for you, and you never even get hit with that. So there's nowhere on a sheet of paper that anyone could measure how much money you make or you save by having representation. There's no like deal structure that says, oh, and because you had McLaren Associates, we didn't drop $1 million bomb on you. It's impossible for anyone to prove how much that is worth, but from personal experience, it is one of the most important parts of this process, is to have representation fight for you and protect you from this deal fatigue so that you've got the energy and so that you don't get the bomb dropped on you and just accept it.
We hear those stories all the time, not from our clients, but
I had it.
Yeah,
I had it myself.
You had it happen yourself.
I've done many deals. I've had it myself. Especially if this is your first or second time only, man, you're really susceptible to this.
Yeah, you're treated differently when you walk in the door with us. And we create that leverage through that marketing process, that bid process on the front end, so that if for some reason they try to play games or screw us and retrade the deal right before closing or through the closing process, we politely remind them, hey, you remember, we had 9 offers on this deal. There's still 8 people sitting at the table that are willing and able to buy this practice. If you want to screw around, we'll pivot and sell the practice to somebody else. And I will say that given the turmoil in the marketplace over the past 12 to 24 months, we have absolutely done that multiple times. Most of the time, they will play nice and be above board because they know we're there from the get-go, right? Most of the time, they won't play games at all. Not only because we have the leverage of having 8 other willing and able buyers, but also for another factor. McLaren is a market maker. If they treat one of our clients poorly, there is a high probability that we never do business with them again. Meaning they don't just lose your deal, they lose hundreds of deals on a go-forward basis. So by having proper representation, the process is night and day different compared to trying to DIY this.
All right, I'm going to try to not interrupt you anymore because we're actually over time. So I apologize for slowing this down, but I'm going to not interrupt you anymore until we get to the very end questions.
No worries, Scott. So I just wanted to go over one case study real quick because I think this shows you how opportunistic DSOs are. So this is a client in Georgia. He was 58 years old, wanted to take his practice to market to obtain administrative support and for exit planning purposes. His plan was to continue working chairside for 3 more years, but he had a large practice, revenue of 3.6 million, EBITDA of 1.2 million, really healthy margin. Must have been one of your clients, Scott. 33% margin. He already had an offer in hand for 6.8 million. So from a legitimate DSO, and he thought that was a hell of an offer. He's like, well, I mean, if I sold this thing to a private buyer, if I could find a private buyer to buy my practice, maybe it trades for $3 million, 3.2 million on a good day. I've got an offer in hand for 6.8 million from a legit DSO, by the way, that my buddy sold to and introduced me to. And he put that LOI in front of his attorney. And luckily his attorney said, hey, hold on, timeout. Is this the only offer you got? Call Brandon, call his team. Let them do an even analysis. Let them do evaluation. Let them quantify what they think they could achieve if they took the practice to market utilizing a bid process and created some competition. The client was actually skeptical about who we were and what we could achieve. We did the valuation and told him, hey, we're pretty confident we can get 8 million by taking the practice to the open market. And he said, are you sure? Are you sure you can cover your fee? Like, I don't want to agree to pay you and end up at the same valuation I'm at today. We said, trust me, we'll run a limited process. We won't even take it to the whole marketplace. We'll take it to the top 10 buyers in your geography that we know are looking for an asset like you have. We ultimately got 5 offers and we closed the deal at a valuation of 9 million. So $1 million over our valuation, right? We set a very realistic expectation with the client. We took the practice to market utilizing a blind bid process. The DSO never knew that we valued it at $8 million. Our goal was to get every dollar we possibly could utilizing that bid process. Closed the deal at $9 million. That's a 7.5 times EBITDA multiple, plus a substantial growth-related earnout. It was a clean deal structure: 75% cash at close, 25% stock in the holding company of the DSO. And if the practice grew post-sale, there were going to be additional payouts to our client. That off-market unsolicited offer at $6.8 million closed at $9 million. That's a premium of $2.2 million. That's about a 35%, 33% premium. Guess who the practice ultimately sold to? It sold to the same DSO that made the $6.8 million offer. Simply by us walking in the door, creating a competitive environment, controlling the narrative regarding EBITDA, that same DSO that had made that unsolicited offer off market came up $2.2 million, and we closed the deal with that company. So that shows you how opportunistic, that shows you how predatory DSOs can be if you don't have proper representation. I encourage anybody who watches this webinar to schedule a discovery call with me. It's 30 minutes. It's confidential. There's no commitment, just to get to know each other, just to chat, establish a relationship, and see if it makes sense to do a deep dive. See if it makes sense to do an EBITDA analysis and quantify what your options are. You can scan this QR code. That'll take you to a link on our website to fill out a free consultation form, or you can just text my cell phone and schedule a call. It'll be with me. 30 minutes, no obligation, but would love the opportunity to speak with you. Love the opportunity to get to know you. And Scott, I appreciate you having me on tonight.
Yeah, if you are thinking about selling, not even sure, at least just thinking about it, anytime in the next 5 years, you need to go ahead and have an EBITDA calculation done. You need to go ahead and have this discovery call so that you understand what your particular custom path might look like. Even if it's 5 years away, if you understand what that looks like, you're going to learn something from this call that is going to be important. And that is also going to get you properly aligned and maybe even more motivated to do what you need to do. So, there's no cost to this. I didn't know you were going to do this, by the way, Brandon. So this is the first time I'm seeing it, but there's no cost to this. It'd be irresponsible for you in your career to not take advantage of having a meeting with the owner of this company to talk about your specific situation. So I really do encourage everyone to take advantage of this. There are no strings attached whatsoever. One other thing, we'll go to the next slide here. If any of y'all are interested, if you haven't been to one of my events, we have a multi-location event that talks about buying and building and merging and selling and valuations and DSO structures and compensation structures for associates and regional manager job titles and all that kind of stuff. Come to our event. If you use this code, you'll save a bunch of money. It'll pay for your flight and hotel probably. Our events are 2 days. They're very intense. If you just go look on our Google reviews or talk to anyone that's been, and you'll see they're best of class. Best of class. It will change your career if you go through this kind of intense training. Also, a couple more things. If you want to ask me questions ever, we just posted my Instagram on the chat here. That is me personally. You'll see photos of my kids. You'll see me lecturing. You'll see some podcast stuff. You can always private message me on Instagram and I will answer it personally. That is me. So I answer a whole slew of messages every day. Feel free to follow me on Instagram, connect with me, ask me a question if you think of something, on another day. Also, post your questions right now so that we can answer some questions before we leave. If you have any questions right now. Last slide here. I've started this new podcast. We had Damon John from the Shark Tank on it. It's called the Dental CEO Podcast. Every week we have a new episode. Some episodes are people like Damon John. Some episodes are dental people. Some episodes are me just speaking and preaching and teaching. And we've got a bunch of downloads already. I really encourage you to check it out. Follow us. Listen to us once a week on your way to work or while you work out. If you don't work out, start working out and listen to us while you work out. And I promise you there's value there. I promise you that you're going to be happy you did. Okay. Before we end this, if anyone has any other questions that weren't already answered, I'll give you 20 or 30 seconds to start typing them in. Otherwise, we will go ahead and wrap this up. I'm going to go back to the slide with your QR code here for people to take one last chance to take a photo of that and reach out to you, Brandon. I've got some thank yous coming in. Any other questions? This was a super thorough webinar. I really appreciate that. We went way over in time, but it was worth it. All right, we've got no other questions that came in. So Brandon, before I give you a chance to say one last thing, I want to thank you for coming on. Thank you for updating us on what's going on. Super important topic. This matters the world to a lot of people. And the fact that you're open and honest about this and willing to take out time in the evening to do this is a gift to us. So I really want to thank you for doing that. Here's your last shot to say one last thing to our audience before we end this webinar.
I appreciate everybody joining us tonight. Scott, thanks so much for having me, and look forward to having an individual conversation with each of you and making sure that you crush it when you go to monetize your business. So have a good evening.
Okay, excellent, everyone. Until next time, hey, remember, we got these webinars on a regular basis. Check them out on our website. We're doing a whole lot of them. They're all over different topics, and just check out, see what applies to you. Thank you, everyone, for logging in. Thank you for supporting us. I hope this was valuable to you, and we will see you next time on the next webinar. Bye-bye, everyone.